It is a Thursday night, and you are sitting on your couch with your laptop open to your bank account. You have been making payments on your house for 7 years now. 7 years of never missing a due date. 7 years of being the responsible adult your parents always wanted you to become. You pull up your mortgage statement expecting to see real progress. After all, you have sent nearly $150,000 to the bank over these 7 years. That is serious money. That should mean something significant. The number on the screen makes your stomach drop. Original loan balance, $280,000. Current balance after 7 years of payments, $251,000. You have paid $150,000. Your debt decreased by $29,000. Where did the other $121,000 go? You stare at the screen trying to make the math work in your head. You check your payment history. No missed payments, no late fees, no mistakes. You have done everything right. But $121,000 of your hard-earned money has vanished. It did not build equity. It did not reduce your debt. It simply disappeared into the financial system like water draining through your fingers. Here is the answer nobody wants to tell you. That money went exactly where it was designed to go. It went to the bank as interest profit, and the structure that made this possible was not an accident. It was architected, calculated, and optimized over decades to extract maximum value from people exactly like you. My name is Alex, and I spend an unreasonable amount of time dissecting the financial systems that keep hardworking people running in place while banks post record earnings. Today, we need to have an uncomfortable conversation about something called the payment trap. It is the reason your credit card balance barely moves, even though you pay every month. It is the reason your mortgage feels like a life sentence. It is the reason banks spend millions of dollars advertising lower monthly payments instead of faster payoff times. Banks make more money when you pay less, not less total, less per month, stretched over more time. And once you understand how this machinery operates, you will never look at a loan statement the same way again. Let us start with the most basic question that most people never bother to ask. When you send a payment to your mortgage company, what actually happens to that money? Most people assume payments work like a simple transaction. You owe $300,000, you send $2,000, now you owe $298,000. Clean, logical, fair. That is not how it works. Not even close. Every mortgage payment gets divided into two pieces, principal and interest. Principal is the actual debt you owe. Interest is the fee the bank charges for lending you money. The split between these two determines how fast you actually make progress on your loan. And here is where the trap snaps shut. In the early years of a mortgage, the overwhelming majority of every payment goes to interest. We are not talking about a reasonable split. We are talking about a structure so lopsided that it borders on absurd. Take a standard scenario. You borrow $300,000 for a home at 6% interest over 30 years. Your monthly payment comes to about $1,800. In your very first payment, roughly $1,500 goes straight to interest. Only $300 actually reduces your loan balance. You send $1,800, your debt drops by $300. The bank pockets $1,500 as pure profit. Month after month, year after year, this pattern continues. You write checks, you feel responsible, you watch your balance barely move, and the bank collects the majority of your payment as revenue. This is not a flaw in the system. This is the system. It has a technical name, amortization. It sounds boring and mathematical on purpose. Nobody questions something that sounds like accounting jargon, but amortization is simply the schedule that determines how your payments split between interest and principal over time. And that schedule is deliberately front-loaded with interest. Here is a number that should make you uncomfortable. On a typical 30-year mortgage, you will pay more toward interest than principal for approximately the first 18 years of the loan. That means for over half the life of your mortgage, the majority of every payment enriches your lender rather than building your equity. 18 years before the scales tip in your favor. 18 years of running on a financial treadmill where most of your effort benefits someone else. Let me put this another way so it really sinks in. If you look at payment number 1 of your mortgage and payment number 223, something remarkable happens at that moment. Payment 223 is the first time in the entire life of a typical 30-year loan that more money goes to principal than to interest. That is 18 and a half years into a 30-year commitment. For the first 222 payments, the bank wins. Only after that does the balance start to shift meaningfully in your direction. Now, let me show you the total damage. That $300,000 mortgage at 6%? By the time you make your final payment 30 years from now, you will have sent approximately $647,000 to the bank. You borrowed $300,000. You paid back nearly $650,000. The difference, around $347,000, is pure interest profit for your lender. You paid for your house, then you paid for it again. Almost. And if interest rates are higher, the damage multiplies. At 7% instead of 6%, that same $300,000 loan generates over $418,000 in interest over 30 years. You would pay more in interest than the entire original loan amount. The bank literally makes more money from your loan than you received in the first place. This assumes you actually keep the mortgage for 30 years. Most people do not. The average homeowner refinances or moves every 5 to 7 years. And every time you start a new mortgage, guess what happens? The clock resets. You go right back to the beginning of the amortization schedule, right back to paying mostly interest, right back to barely touching your principal. This is why banks love refinancing. This is why they send you letters offering lower rates and better terms. Every refinance puts you back at square one of the interest extraction cycle. You feel like you got a deal. They know they just extended their profit runway by another decade or two. Think about what this means for the average person. You buy your first home at age 30. You refinance at 35 for a lower rate. You move to a bigger house at 40. You refinance again at 45 when rates drop. By the time you are 55, you have made mortgage payments for 25 years, but you have never gotten past the interest-heavy early phase of any single loan. You have been paying mostly interest your entire adult life. The banks understood this pattern decades ago. They built their entire business model around it. Let me walk you through a real scenario that plays out in millions of households. You buy a house with a 30-year mortgage. 5 years in, rates drop and you refinance into a new 30-year loan. Your payment goes down $50 a month. You feel smart. You feel like you won. But here is what actually happened. You spent 5 years slowly crawling toward the point where more of your payment goes to principal. Then you erased all that progress and started over. You added 5 more years to your total repayment timeline. And over the life of the new loan, you will pay tens of thousands more in interest than if you had just kept the original mortgage. The $50 you saved each month will cost you a fortune over time, but that fortune gets paid slowly, invisibly, month by month, so you never feel the full weight of it. This is the payment trap in its purest form. Lower monthly payments almost always mean higher total cost. But human brains are not wired to think in 30-year horizons. We think about this month, this paycheck, this bill. Banks understand this perfectly, and they exploit it ruthlessly. Now let us talk about credit cards. Because if mortgages are the payment trap on a slow simmer, credit cards are the same trap with the burner cranked to maximum. You have a credit card with a $5,000 balance and a 23% interest rate. The minimum payment is around $150. That seems manageable. You pay it every month and feel like you are handling your business. Here is the reality. Out of that $150 payment, roughly $100 goes to interest. Only $50 reduces your actual debt. At this pace, paying off that $5,000 balance will take you over 2 decades. And by the time you are done, you will have paid nearly $9,000 in interest on top of the original $5,000. You bought $5,000 worth of stuff. You paid $14,000 for it. And that is with a 23% rate, which is actually around average right now. Some cards charge 28 or 29%. At those rates, the math becomes even more brutal. A $5,000 balance could generate over $22,000 in interest if you only pay the minimum. That is more than 4 times your original debt vanishing into bank profits. The minimum payment exists for one reason: to maximize the amount of interest you pay over time. Credit card companies figured out decades ago that smaller required payments lead to longer repayment periods, which lead to more interest revenue. They literally lowered minimum payment requirements over the years because it made them more profitable. In the 1970s, minimum payments were typically around 5% of your balance. Today, they hover around 2%. That is not consumer-friendly evolution. That is profit optimization disguised as flexibility. And it gets worse. Research shows that simply displaying a minimum payment amount on your statement makes people pay less. When you see that small number, your brain anchors to it. You think that is what you should pay. You think that is normal. You think that is enough. It is enough for the bank. It is devastating for you. Let me give you an even simpler example to drive this home. You buy a television for $1,000 on your credit card at 18% interest. You pay only the minimum each month. Seems reasonable. $1,000 is not that much debt. Except paying the minimum on that $1,000 will take you over 12 years to pay off, and you will pay an additional $1,400 in interest. Your $1,000 television cost you $2,400, and it took you 12 years to pay for something that probably broke after 5. Here is what the bank understands about human psychology that you probably do not. We are terrible at calculating compound interest intuitively. We cannot feel the difference between paying off debt in 5 years versus 15 years. Both feel like the distant future. Both feel abstract. But banks live in spreadsheets. They know exactly how much money they make when you stretch payments over time. They know that a $5,000 balance at minimum payments generates almost triple the original amount in revenue. They have actuaries and algorithms calculating these returns down to the penny. You are making emotional decisions about money. They are making mathematical ones. That asymmetry is where their profit lives. Now, I need to explain how banks actually make money, because most people have a vague understanding at best. The core business model is elegantly simple. Banks borrow money at low rates and lend it at higher rates. They pocket the difference. This is called the spread, and it is the engine that drives banking profits. When you deposit money in a savings account, the bank pays you interest. Currently, that might be around 0.5% if you are lucky, maybe 4 or 5% if you shop around aggressively for a high-yield account. Then the bank takes your deposit and lends it out as mortgages at 6 or 7%, as credit cards at 23%, as personal loans at 12%. The difference between what they pay you and what they charge borrowers is pure profit. Here is a simple illustration. You deposit $10,000 in a savings account earning 0.5%. The bank pays you $50 over the course of a year. Then the bank lends that same $10,000 to someone else as part of a mortgage at 6%. They collect $600 in interest. After paying you $50, they keep $550 as profit. Your money made you $50. It made them $550. Now think about what this means from the bank's perspective. They want depositors to keep money parked and earning minimal interest. They want borrowers to keep loans active and paying maximum interest. The longer money stays in the system, the more they extract from both sides. Short-term deposits and long-term loans are the ideal combination. You can withdraw your savings whenever you want, so they pay you almost nothing, but your mortgage is locked in for 30 years, so they collect interest for decades. This is why banks push 30-year mortgages instead of 15-year options. Yes, the monthly payment is lower, but the total interest is dramatically higher. A $300,000 loan at 6% over 30 years generates around $347,000 in interest. The same loan over 15 years generates about $156,000 in interest. The bank makes nearly $200,000 more on the 30-year option. Of course, that is what they recommend. Of course, that is what they advertise. Of course, that is what most people end up with. Let me tell you about the refinancing trap in more detail, because this is where banks really demonstrate their genius. You have been paying your mortgage for 10 years. You have finally reached the point where a meaningful portion of your payment goes toward principal. You are building equity. You are making progress. Then rates drop by 1%. Your bank sends you a friendly letter. Refinance now and save $200 a month. It sounds amazing. So you refinance into a new 30-year mortgage. Your payment drops. You celebrate. But here's what you actually did. You took a 20-year remaining balance and stretched it back to 30 years. You went from being 10 years into your amortization schedule to being at day 1 of a brand new schedule. You reset the interest extraction clock entirely. That $200 a month you saved, over the next 30 years, you will pay an extra $100,000 or more in total interest compared to keeping your original loan. Someone who refinanced a $200,000 mortgage from 6% to 4.25% after 5 years, stretching it back to 30 years, would pay approximately $193,000 in total interest across both loans. If they had kept the original, they would have paid around $199,000, $6,000 in savings for resetting a decade of progress and adding 5 years to their debt timeline. The monthly statement looks better. The lifetime cost is nearly identical. The bank wins either way. This is not an argument against all refinancing. Sometimes it makes genuine sense. But you need to understand what you are trading. You are exchanging long-term wealth for short-term cash flow. And in almost every case, the bank comes out ahead. Now let me show you how wealthy people think about debt completely differently than the middle class. Average people view debt as something to minimize monthly payments on. They want breathing room, they want flexibility, they want the smallest possible number on each bill. Wealthy people view debt as a tool with a cost. They calculate total interest paid, not monthly payment size. They understand that low payments stretched over time equal high total cost. The middle class celebrates when they lower their mortgage payment by $50. The wealthy calculate how much extra interest that $50 reduction will cost over the loan term. Here is a pattern that shows up consistently in financial research. The more money people have, the less of their wealth sits in home equity, and the more sits in financial assets, like stocks and bonds. Wealthy households typically have $4 in investments for every $1 in home equity. Middle-class households have the opposite $4 in home equity for every $1 in other assets. Why does this matter? Because home equity is illiquid and generates no income. Your house might be worth $500,000, but that money is trapped in walls and floorboards. You cannot spend it. You cannot invest it. It just sits there looking impressive on paper. Meanwhile, investments generate returns, dividends, growth, compound interest working for you instead of against you. The wealthy understand that paying off a 4% mortgage aggressively, while the stock market historically returns 8 to 10%, is mathematically backwards. They keep the cheap debt. They invest the difference. The spread works in their favor instead of the bank's favor. This is using the bank's own game against them. But here is the critical point. This strategy only works with discipline. If you keep a mortgage to invest the extra money, you have to actually invest the extra money. Most people do not. They keep the mortgage, spend the extra money on lifestyle inflation, and get the worst of both worlds: long-term debt and no investment growth. The wealthy also understand the difference between high-interest debt and low-interest debt. Credit card debt at 23% is an emergency. Mortgage debt at 4% is a tool. Average people often do the opposite. They aggressively pay down their cheap mortgage while making minimum payments on expensive credit cards. They focus on the biggest balance instead of the highest rate. This is financial triage performed backwards. You are bandaging a paper cut while ignoring a severed artery. If you have credit card debt, that is the fire you extinguish first. Not because the balance is big, but because the interest rate is brutal. A $5,000 credit card balance at 23% costs you over $1,000 a year in interest alone. Paying that off is equivalent to earning a guaranteed 23% return on your money. Nothing else in your financial life offers that kind of guaranteed return. Not your retirement account, not real estate, not any investment vehicle on the planet, nothing. Now let us talk about what you can actually do with this information, because understanding the trap is only useful if you know how to escape it. First, understand your amortization schedule. Pull it up for every loan you have. See exactly how much of each payment goes to interest versus principal. Watch how slowly that ratio changes over time. Let the reality of those numbers sink in. Most people have never looked at this document in their entire lives. They sign it at closing and never think about it again. That ignorance is expensive. Second, make extra principal payments whenever possible. Even small amounts make a significant difference because they bypass the interest calculation entirely. An extra $50 per month toward your mortgage principal can shave years off your loan and save tens of thousands in interest. When you make extra payments, explicitly designate them as principal only. Otherwise, the bank might just apply them to future payments, which does not help you at all. Call your lender. Send a separate check labeled principal only. Make sure the money goes where it actually reduces your debt. Third, think very carefully before refinancing. Calculate the total cost of your current loan versus the new loan. Factor in closing costs. Factor in the reset of your amortization schedule. Make sure you are actually saving money over the life of the loan, not just the life of your monthly budget. If you must refinance, consider refinancing into a shorter term that keeps you on track or close to your original payoff date. Or refinance to the lower rate, but keep making your old higher payment. The extra money will go straight to principal and you will avoid the timeline extension trap. Fourth, attack high-interest debt with ferocity. Minimum payments on credit cards are a trap specifically designed to maximize bank profits. Pay as much as you possibly can. Sell things. Work extra hours. Cut expenses. Do whatever it takes to break free from 20% plus interest rates. Use the avalanche method. List all your debts by interest rate, highest to lowest. Pay minimums on everything except the highest rate debt. Throw every extra dollar at that one until it is gone. Then move to the next highest. This approach minimizes total interest paid and gets you out of debt faster than any other strategy. Fifth, once you escape high-interest debt, do not let yourself get sucked back in. The average American household carries around $6,000 in credit card debt. Most of that accumulates gradually, purchase by purchase, month by month. The trap works because it feels manageable in the moment. Build an emergency fund so you do not need credit cards when unexpected expenses hit. 3 to 6 months of living expenses and accessible savings keeps you from sliding back into the high-interest hole every time the car breaks down or the furnace dies. Sixth, reframe how you think about monthly payments. Stop asking whether you can afford the payment. Start asking what this loan will actually cost you in total. A car loan that fits your budget at $400 a month might add up to $30,000 over 6 years. Is that car worth $30,000 to you? Ask the dealer or lender for the total amount you will pay over the life of the loan. Watch how uncomfortable they get. That discomfort tells you everything about whose interests that number serves. Finally, recognize that the entire financial system is optimized to extract money from people who think short-term while rewarding people who think long-term. Banks, credit card companies, auto dealers, mortgage brokers, they all make more money when you focus on monthly payments instead of total cost. Every time someone offers you a lower monthly payment, ask yourself, what is this actually costing me? The payment trap works because it exploits a fundamental mismatch between how humans naturally think and how financial math actually works. We feel monthly payments. We do not feel 30 years of compounding interest. Banks feel all of it. They see every dollar they will extract from you the moment you sign that loan document. They have already calculated their profit while you are still celebrating your new house or new car or available credit line. This is not about banks being evil. They are businesses maximizing revenue, exactly like every other corporation. But you need to understand that their profit goals and your wealth goals are fundamentally opposed. Every dollar they extract in interest is a dollar that does not compound in your investment account. The question is simple. Whose financial future are you building with each payment, yours or theirs? Stop celebrating small monthly payments. Start calculating total lifetime cost. Stop refinancing for breathing room. Start building equity that compounds. Stop making minimums. Start making progress. The payment trap only works if you do not see it. Now you do. What happens next is entirely up to you.